U.S. stocks are having another strong year, but it's a mixed picture outside of the United States. Europe is seeing small gains, and Japan is having a strong year, but the rest of Asia generally underperforming, particularly China. Here to discuss, Brendan Ahern, Chief Investment Officer at KraneShares, who manages the KraneShares China Internet ETF. That's KWEB, as we call it. And of course, we also have John Beatson, co-CIO and Managing Director at Sepio Capital. Brendan, I want to start with PDD, Pinduoduo,
Yeah.
as the company is. It's one of your largest holdings. They had a big revenue miss today. I think it's down 30%. This is the parent of Temu, the fast fashion retailer. They compete very much with Uniqlo, with Zara, Shein, another Chinese fast fashion competitor. Fast fashion seems to be having a tough moment here, right?
Yeah, I mean, the company grew 86% for the quarter year over year, but that was a miss from analyst expectations. At the same time, really on the press release as well as on the management call, you had a very, very strong emphasis on increased competition within the space, particularly that's weighing on JD and Alibaba today. The company is not going to do a buyback nor pay a dividend, as well as the company talked about investing in their own business, and that might actually jeopardize the profitability that the company had come to. So net, it was not a great read from management. The stock had been up about 70% over the last year relative to the space, its peers. So it's a bit of a crowded long, and I think it's paying for that at the moment.
Yeah, my sister loves them and buys $9 dresses from them. So they seem to be popular, and yet when you look at stores here in the United States that compete against them, Zara, they have stores here, and of course Temu doesn't. It's a pretty tough business to turn around. You're constantly turning over inventory, right?
Sure. It's and trying to navigate what consumers want and trying to get ahead of those trends. So again, the company's hyper growth and just that slight miss leads to a big drop today.
China, I want to just get broad thoughts from you. Notably underperforming so far this year. The Shanghai Composite is down 4% year to date. The Shenzhen Composite, which is tech-oriented, is down 18%. Hong Kong's only up 4%. And this is with the S&P up, 16% on the year. What is causing China's underperformance, and why is mainland China stocks particularly underperforming?
You have a very tepid economy in China where the government has not gone into strong fiscal policy to lift the economy. Export-driven manufacturing has been strong, and yet domestic consumption has been very, very light due to zero COVID, that kind of scar tissue, as well as a real estate crisis in China that's really weighed on the balance sheet of the household. So I think investors, particularly in mainland China, that Shanghai, Shenzhen, very much looking for much stronger fiscal support from the government. And thus far, we've been left waiting. Growth stocks in Hong Kong, like we hold in KWEB, have held up a bit better, and I think some of that's just money coming maybe out of significant outperformers like US tech, Japan, and India to buy some cheap China tech.
Now you run the China Internet ETF, KWEB as we like to call it. You've got $4.7 billion in assets under management. It's one of the bigger China ETFs out there. But even with some big names like Tencent up 30% this year, you're still down 6% this year. I know Pinduoduo is a big holding for you, might be 10%, but it seems all over the place. Even China tech stocks, in theory, should be doing well. Look, it's just all over the place. Here's your largest holdings, but Pinduoduo, PDD, is down big today. But
I mean, the companies have no AI premium given to them, unlike their U.S. equivalents.
Yeah, given how big, like Meituan or Alibaba or JD.com, you could do anything, on a message site with these people.
Baidu.
You'd think they'd own the world.
Yeah, exactly. I mean, they get no credit for that. And I think just stepping back, big picture, you have this incredible U.S. equity outperformance, and just a lot of things are really out of sight, out of mind, particularly China tech at the moment. But again, I think you need to see policy amplification, and then you'll see investors kind of come back into this space.
I want to bring a new contributor to ETF Edge. I'm very excited to chat with him. John Beatson is the co-CIO and the managing director at Sepio Capital. Sepio is among a very small group of financial managers. They not only manage money, they've started their own ETFs. Why I was interested in John. He also manages the Capital US Equity ETF. The symbol is SMRI, which began trading 10 months ago. It's a value fund. John, I want to talk about your ETF, but before we get to that, you've heard what we were talking about here with Brendan and I. Your thoughts on China as an investment in general, any other thoughts on emerging markets as well?
Yeah, on EM broadly, if you're focused as we are on risk management, the majority of the large passive EM ETFs have anywhere from 40 to 43% exposed to just China and Taiwan. So it's not our base case, but there is a probability greater than zero that there is a geopolitical event around China and Taiwan. Now, China, you could argue, has at least some of that risk priced in. The CAPE ratio for China is around 10 times. It's trading for 1.1 times book. So at the index level, you could argue it's fairly attractively valued. Taiwan, on the other hand, is trading for a CAPE of 29 times and 3.6 times book value. So arguably, that market, we would think, is not properly pricing in the risk that there is a geopolitical event around China.
Well, Brendan, get a response to that. I mean, he's got a good point here. There is political risk in we don't know what Xi Jinping is actually doing. He seems to be trying to get more control of the economy, so less capitalism. And then there's the Taiwan risk. As he pointed out, the market knows this, so this is to a certain extent priced in. This seems to be a factor in the underperformance, though.
Yeah, I think it is a factor. At the same time, U.S. investors are highly exposed to China implicitly through U.S. multinationals that generate a huge amount of revenue in point. China.
How much revenues does Apple get from it?
Apple's 16%, Tesla's about 25%, ExxonMobil 10%, and then Boeing, Nike, Starbucks. So again, you have a lot of, and there's no discount given to these U.S. names over the same risk. At the same time, I think what allows us to sleep at night is China's economy is so geared to the West that if you saw Russia has been ostracized from the global economy, from global financial markets, China can't take that risk. Their economy needs the West, and I think that's lessens the likelihood of a forcible takeover of Taiwan. Just they have everything to lose and nothing to gain in doing so.
Yeah, it's a good point.